Silver isn't at $600 in spot terms, but the market is behaving like it's running out of time, and that's the part the mainstream keeps trying to laugh off while the spread quietly tells the truth. The $600 number is the kind of headline that gets people either euphoric or instantly dismissive, and both reactions are useful, just not to you, because the real story right now isn't a TA meme price tag. It's the way silver is trading like a stressed asset, fast, jumpy, and increasingly sensitive to delivery funding and positioning. And I'm going to make you a promise up front. By the end of this, you'll have 3 concrete things to watch over the next week or two, the levels that actually matter, and the one hidden detail that flips this whole setup from hot narrative to structural pressure. Aye. Because if that one detail keeps tightening, the math changes. And it changes in a way that forces people to buy, not because they suddenly became believers, but because the market structure doesn't give them a choice. Here, it's the real tape. Silver started this month down around the low 70s per ounce and ripped up into the 90s, printing fresh highs along the way. And the pace alone is the first alarm bell. Moves like that don't happen in a calm, well-supplied, comfortably financed market. They happen when liquidity thins, positioning gets lopsided, and the easy side of the trade runs out of oxygen. And that's where the real pressure starts. Now, I know exactly what the pushback sounds like. You'll hear, it's just fear. You'll hear, it's just a headline about tariffs. You'll hear, silver's volatile, this is normal. But the market's telling you something more specific than emotion. It's telling you that time matters. And in commodities, when time starts to matter, it shows up first in the curve, not in your favorite chart screenshot. Everyone's staring at the headline story. Trump this, tariffs that, geopolitical noise, while the signal is in the plumbing, the curve, the spreads, the availability of deliverable metal, and the behavior of participants who can't afford to be wrong for even one settlement cycle. But that's not the part that matters yet. The next detail is what flips the whole setup. In metals, the biggest lie is inventory. Because inventory is not one thing, there's metal that exists somewhere on Earth, and then there's metal that can actually be delivered to satisfy a contract when it matters. Those are not the same. Warehouses can look full, and the market can still feel tight because the deliverable slice, the portion that is registered in the right form in the right place with the right ownership willingness, is what sets the tone when futures come due. And when that deliverable slice feels constrained, the market starts paying up for time. That's the hidden detail, not the headline level, the time premium. When the curve shifts from store it later toward pay up for it now, that's a physical signal trying to break through a paper world. And if you've never paid attention to contango and backwardation, don't worry. This is simpler than it sounds. Contango is when future prices are higher than near prices because storage and financing cost money. And the market is basically saying, no rush, we've got time. Backwardation is when near prices are higher than future prices, and the market is saying, I need it now, and I'll pay for now. Backwardation doesn't guarantee a moonshot, but it's the market's way of revealing urgency. And urgency is contagious, because urgency forces behavior. That's the theme of this entire video, what it forces people to do. Now stack the calendar on top of that, because the calendar is the catalyst that turns normal stress into chaos. January is not just another month. It's when benchmark money rebalances, when New Year allocations get put to work, when liquidity can be deceptively thin, and when the first big trend of the year can pull in capital that has mandates, not opinions. Add to that the mechanics of rolling futures, the delivery windows, and the way options positioning can amplify moves into certain dates, and suddenly a modest dislocation can become a violent price gap. And if you've been around metals long enough, you know the weekend gap risk is real too. You go to sleep on Friday thinking you saw buy the dip on Monday, and you wake up to a different market. That's why now matters. Because the same story told in a deep liquid environment is noise. Told into thin liquidity near key dates becomes a lever. But here's where the politics headline plugs into the plumbing without needing cartoonish conspiracy. Policy changes incentives. Even the threat of policy changes incentives. And in commodities, incentive shifts show up as rerouting, hoarding, and repricing of risk. Recent U.S. actions and commentary around processed critical minerals, national security investigations, and trade measures are exactly the kind of thing that changes how traders price supply chain vulnerability. You don't need a dramatic seize the silver fantasy to create a premium. You just need uncertainty that makes a rational participant say, I want my metal in my jurisdiction, in my vault, in the form I need, and I want it before rules change. That's it. That's the mechanism. And it doesn't take much because silver is one of those weird markets where it can feel big on a chart and still be small enough in deliverable terms that a concentrated wave of demand can move it. And that's where the market gets reflexive. Because physical demand doesn't have to win the whole war. It just has to stress the right bottleneck at the right time. Now zoom out for a second and watch the conflict playing out in real time. On one side, you have narrative managers, people who want this move to be temporary, emotional, headline-driven, and therefore fadeable. On the other side, you have structure traders and real users, people who watch spreads, inventories, financing, and delivery. The first group is trying to suppress the significance of the move because their framework is everything mean reverts. The second group is watching the market quietly change the rules, near-month tightness, cost of carry distortions, and a price path that punishes anyone who thinks they can casually short because it's too high. And if you're a skeptic of institutions, here's the honest version. It's not that there's a single villain pulling a lever. It's that a lot of big players share the same incentives, and incentives create patterns. If you're short vol, you want calm. If you're short metal, you want time. If you're managing risk at a desk, you want to reduce exposure before it becomes existential. Those incentives can look like suppression from the outside, but inside the machine, it's just risk management. And risk management in a stressed market becomes forced buying. But that's not the part that matters most. The part that matters most is the location problem. Silver can be plentiful globally and still scarce where the benchmark is set. It can be sitting in the wrong geography, in the wrong form, under the wrong ownership, while the contract that sets global reference pricing is demanding deliverable metal somewhere else. This is how squeezes are born, not from a lack of atoms, but from a mismatch between where the atoms are and what the market can use right now. And that mismatch is exactly where arbitrage steps in. Arbitrage is the invisible hand that drags price toward reality. If spot and futures diverge too much, or if one region trades at a premium, arbitrageurs try to move metal or hedge exposures to capture that spread. But here's the punchline. Arbitrage requires logistics, refining, time, and financing. In a frictionless world, spreads would stay tame. In the real world, bottlenecks make spreads scream. And when spreads scream, it's the market admitting there's friction. And friction is bullish fuel until it's resolved. So what are the proof points you can actually hold on to instead of vibes? First proof point, the curve behavior. When silver rips this hard and holds elevated levels, watch whether the nearby contracts stay tight relative to deferred months. If the market keeps paying up for now, that's a real-time stress gauge. It's not a tweet. It's not a pundit. It's a price of time. And when the price of time rises, it forces shorts to respect the clock. Second proof point, the nature of inventory is not just the totals. If you see vault headlines, don't just ask how much. Ask what kind. Deliverable categories matter. A big warehouse number can hide the reality that the deliverable pool is not expanding, or that metal is sitting in an eligible status where it exists, but isn't T-committed to delivery. The market can look stocked and still behave tight because willingness to deliver is the real commodity. And that's where the real pressure starts. Third proof point, institutional flow behavior. ETFs and ETPs don't have to be the whole story, but they are a transmission mechanism. When investment vehicles absorb metal or demand hedges, it changes the flow balance. It can pull supply out of circulation, tighten physical availability at the margin, and force futures participants to adjust. The key is not to worship ETF numbers, but to recognize that they can turn a trend into a feedback loop. Fourth proof point, premiums and availability in the street-level market. When the chart says one price and the physical retail and wholesale world shows delays, higher premiums, or rationing behavior, that's the market whispering, paper and physical are negotiating. Not always, not forever, but when it happens alongside a tight curve, it matters. Fifth proof point, cross-market and regional price behavior. If you see certain venues or currencies pricing silver aggressively, like local markets printing levels that feel disconnected from the dollar chart, that can be a clue that the demand isn't just speculative. In early 2026, for example, you've seen silver in some markets surge toward record local currency levels, which tells you they're at a safe haven bid, plus a currency stress component layered on top of the metal story. And the next detail is what flips the whole setup. Silver AS supply chain can just respond on demand. Silver is often produced as a byproduct of other mining, lead, zinc, copper. So you don't just crank a dial and get 20% more silver next quarter because price went up. Refining, assay, fabrication, and logistics are real bottlenecks. Recycling helps, but it has lead times and price sensitivity too. That means when demand arrives suddenly, whether it's investment demand, industrial procurement, or both at the same time, near-term supply is inelastic. And when supply is inelastic, price is the rationing mechanism. That's not conspiracy. That's economics. Now layer in the demand engine because silver is special in the way it straddles two worlds. It has a monetary bid when confidence cracks. Safe haven behavior, inflation hedging, distrust in institutions. And it has an industrial bid when technology and energy infrastructure require the metal. When those two buyers show up simultaneously, things get wild because they don't negotiate the same way. The industrial buyer often needs metal on a schedule. The macro buyer often needs exposure before a narrative becomes consensus. Those are both time-sensitive motivations, and time-sensitive motivations show up in, you guessed it, the curve and the spreads. But that's not the part that matters yet. The part that matters is how positioning turns this from a trend into a squeeze. When silver moves this fast, it doesn't just reward longs, it punishes complacency. Shorts start managing survival. Dealers start hedging options exposure. Funds that underweight commodities start scrambling to catch up. And when enough participants are forced to do the same thing at once, cover, hedge, rebalance, you get verticality. You get those candles that look stupid until you realize they're not emotional at all. They're mechanical. This move isn't emotion, it's math. And math doesn't care what your opinion is. Here's what that math looks like in plain language. If you're short futures, rising price increases your margin requirements. If volatility rises, your broker or clearinghouse can demand more collateral. If you don't have it, you reduce risk, which often means you buy back what you shorted. That's short covering. Short covering is buying. Buying pushes price up increases margin. Margin increases, forces more covering. That's the spiral. It doesn't need a villain, it needs leverage. And silver, because it's historically volatile, is basically a leverage detector. It finds weak hands and forces them out. And that's where the real pressure starts. Now, I'm not going to pretend there are no counterpoints, because this is where trust lives. Silver can whip around violently, even if the thesis is correct. That's not a disclaimer. That's a feature of the market. In a stress regime, you can have a bullish structure and still get a brutal pullback because liquidity vacuum cuts both ways. You can have a day where the market drops hard, just to flush late longs, trigger stops, and reset positioning before it continues. You can have a headline that temporarily diffuses the policy premium. You can have a surge in supply offered into strength. You can have a broader macro shock, say rates spike or the dollar rips, and metals get smacked because the whole complex delivers. So if your brain wants certainty, silver will punish you. Instead, you need a two-scenario lens. Scenario 1 is the controlled pullback and retest. Price cools off, revisits a prior breakout zone, spreads relax a bit, but don't collapse, and buyers step in aggressively on dips. That's the healthy bull. Scenario 2 is the continuation squeeze. Price refuses to retest politely, liquidity thins, and you get gaps, up or down, around key dates, because the market is clearing imbalances, not offering bargains. In a squeeze scenario, the risk is you don't get the entry you want. In a retest scenario, the risk is you mistake a normal pullback for thesis failure, and that's exactly how volatility manipulates you. The market will try to make you buy high in excitement and sell low in fear, even when the structure hasn't changed. So here's your psychology shield. Stop treating every candle as information. Most candles are noise. The trend signal is in how the market behaves around key levels and in whether the structural indicators, curve tightness, deliverable behavior, and dip absorption stay intact. If the market dumps on a scary headline but recovers quickly and spreads remain firm, that's often strength disguised as drama. If the market rallies on hype but spreads relax and dips don't get bought, that's often weakness disguised as euphoria. The next detail is what flips the whole setup. The levels matter, but only in context. Right now, with silver having printed into the 90s, the obvious psychological magnet is the triple digits, $100 per ounce. Markets love round numbers because humans love round numbers, and that means there will be positioning around it. Ahead of that, the zone in the low to mid-90s is the current battlefield, because it's where the move accelerated. If price stays above the prior breakout region, think high 80s into around 90, and dips get instantly absorbed, that's your confirmation that demand is real, not just speculative froth. If price loses that area, chops, and the bounce attempts get sold, that's your first warning that the market is trying to deflate the premium. Below that, the mid-80s become the next line where the math changes, because that's where a lot of late buyers emotionally anchor as fair. Break below, and you can trigger another wave of de-risking. But, and this is important, a break below a level doesn't automatically kill the thesis. It tells you the market is testing whether the new demand is patient or panicked. What invalidates the squeeze-style bullish setup more cleanly is not a one-day dump. It is a sustained relaxation of the curve and a visible return of availability into the deliverable pool combined with weak dip buying. That's what you watch. Because if the stress goes away, the stress premium goes away. Now let's talk about what comes next. Because this is where most content turns into vague motivational speaking, and we're not doing that. Over the next week or two, you're watching three things like a hawk. 1, does silver hold its gains without needing constant new headlines? A market that can stay elevated on its own is a market where participants are structurally committed. 2, does the curve stay tight in the nearby months? That's your hidden detail scoreboard. If the market keeps paying for immediacy, it's telling you the physical and financing side is still constrained. 3. Do pullbacks get bought fast, or do they drift? Fast dip buying means there's a bid underneath, potentially institutional. Slow drift means the move is losing urgency. And the next detail is what flips the whole setup. Watch the behavior into calendar pressure points. As month-end approaches, as funds rebalance, as contracts roll and deliveries loom, the market often reveals its hand. If participants are nervous about being short into a delivery window, they cover early. If they're comfortable, they press. Those are different tapes. You can feel it. You'll see it in how quickly sell-offs snap back, in how spreads behave, and in whether the market gaps on low liquidity. This is why the act now energy exists in the first place. Not because you should chase, but because the environment is one where the market can move faster than your emotions can keep up. And that's where your risk management has to be adult. The reminder you need to hear is simple. Even if the bull thesis is right, price can whip around violently. Trend signal is not the same as day-to-day noise. If you can't emotionally tolerate a 10% swing in a week, you don't have a silver trade. Silver has you. So you frame it properly. You decide your time horizon. You decide your invalidation conditions. You decide whether you're a structure watcher or a headline reactor. Because the market will happily turn you into liquidity if you're the second one. Now, let's address the institutional angle with grown-up language. When people say they're suppressing it, what they often mean is the structure favors paper claims until physical constraints force reconciliation. That's a real idea, and you don't have to turn it into a courtroom drama. Futures markets are designed for hedging and price discovery, and they work most of the time. But when a lot of participants treat paper as a substitute for physical exposure, and then a moment arrives where physical demand or policy risk makes substitute feel unsafe, the system strains. Strain shows up as spreads, as funding stress, as a scramble for deliverable units, as sudden volatility. That's the paper versus physical tension people sense. It's not magic, it's settlement reality. And the next detail is what flips the whole setup. If that tension persists, price doesn't need to go to a fantasy number to produce real consequences. It can change industrial procurement behavior. It can change hedging costs. It can change how funds allocate. It can change the narrative from cute volatility to strategic scarcity. And that narrative shift itself can attract new flows. That's reflexivity. The market moves, the story changes, the flows change, the market moves more. But, and this matters, reflexivity can also reverse if the stress resolves. That's why you don't fall in love. You stay evidence-driven. So let IS do the evidence-driven checkpoint in one breath. We've seen a dramatic month move. We've seen local market pricing surge in some regions. We've seen policy and trade uncertainty add a risk premium. We've seen a setup where deliverable reality matters more than total inventory headlines. And we've seen the perfect calendar environment for mechanical flows to amplify volatility. That's a real stack. That is not one argument. That's mechanism, flow, calendar, supply chain, and psychology all pointing in the same direction. But that's not the part that matters most. The part that matters most is what you do with it. If you chase because you're scared of missing out, the market will use you. If you dismiss because you're scared of being wrong, the market will leave you behind. The correct posture is watch the structure, respect the volatility, and let the market prove itself. If silver pushes above the recent highs and holds, the psychological magnet becomes $100, and above that, the air can thin fast because round numbers trigger both profit-taking and forced hedging. If silver pulls back into the high 80s or around 90 and buyers step in aggressively, that's the controlled retest scenario. If silver loses those zones and the recovery is weak while the curve relaxes, that's the deflation scenario. It's not complicated, it's just disciplined. And here's the subtle community point, because this is how you actually win in markets. You stop trying to be the hero alone, and you become part of a group that watches the right things. Not the loudest things, the right things. If you're the kind of person who wants mechanisms, not slogans, and you want a checklist instead of a prophecy, then you're already in the right tribe. Stay with the structure watchers, not the headline chasers. Because over the next couple of weeks, the market is going to do what it always does in a stress regime. It will try to shake you out with volatility, then it will make the move look obvious in hindsight, and then it will punish late certainty. Don't play that game. Play the curve, play the calendar, play the forced behavior. And remember the hidden detail that started this whole conversation. Price is the headline, but the spread is the confession. If the confession keeps getting louder, you're not watching a meme. You're watching a market that can't unsee its own constraint. And once a market can't unsee that, it stops negotiating politely. It starts clearing.